please have the experts on where to invest come up to the podium and join Alexis. As they come up, I will welcome each one of them with an introduction. Mark Skousen was named one of the top 20 living economists in the world. He has been appointed a presidential fellow at the Chapman University in California and has the unique distinction of having worked for the government, CIA, nonprofits, and has launched a fantastic event as the founder of the largest gathering annually of free minds called Freedom Fest, held every July here in Las Vegas. I also attend that event. Thomas Grimes works in institutional sales at Reeves Asset Management, an employee-owned research-based investment management company specializing in key infrastructure-related industries such as utilities, energies, telecommunications, and water. Mr. Grimes holds a finance degree from Georgetown University. Peter Schiff is one of the few widely known economists, outspoken, I might also add, and investment professionals to have spoken about the financial crisis before it began. He is widely followed opponent of debt-fueled growth policies and known for his advocacy for emerging market and commodity-focused investments in countries with positive fiscal characteristics. And one of my favorite friends, Keith Fitz Gerald, is a seasoned analyst, trader, and consultant with 36 years of experience in global markets. As chief investment strategist for Money Map Press since 2007, he is one of the most widely read market experts on the planet with more than 3 million readers. So please give a warm welcome to Alexis and these wonderful panel of experts. Thank you.
Thank you, Kim. Thank you all for being with us. So I checked the markets just before I came up, before the Dow was up about 300, NASDAQ up about 100. So we're basically getting whipsawed in this market right after the big two declines that we saw Friday and Monday. The president tweeted this morning, "We'll make a deal when the time is right." And I guess that gave investors a little bit of optimism. I want to go down the line and just ask, is this a sucker's rally, and is caution sort of the name of the game right now?
Well, I think we're in a bear market. I mean, I think the rally that actually took us briefly to new highs was still a bear market rally. I think the market really peaked out in January of 2018. And I think there's a lot of downside in the market. I think the trade war is only going to make it worse, but there is a much bigger problem that we have. You know, the Federal Reserve inflated this bubble. And when I was here at the Money Show last year, I made a prediction that the Federal Reserve would have to abort prematurely its attempt to normalize interest rates, and it would never be able to shrink its balance sheet by any meaningful amount. Those predictions have now come true. The reason that the Fed had to do that was because we have so much debt as a result of them having kept interest rates for so low for so long that it is impossible to normalize rates or shrink the balance sheet. But it was the false belief that the Fed could accomplish that. That is the reason that we had the dollar rally, the reason that the market rallied. But I do believe that in this next recession, that will be worse than the one we had in 08, the Fed will go back to zero, they will go back to QE, but instead of inflating another asset bubble like they did in the past, they're just going to prick the bubble in the dollar, and I think we're going to have an inflationary recession, and it's going to be a very difficult environment for U.S. stocks.
All right, way to go to kick us off on a positive note. The glass is half full. Tom, what's your take? Is this a market that you should be becoming more invested in at this point?
This is a market that people at my firm like very much because we're very conservative investors. Utilities have been a big part of our portfolios for the last 40 years, along with oil stocks and telephone stocks. So conservative, boring dividends, slow and steady. We only get attention on days like yesterday when everything was down except utilities.
Right.
Yeah. So we're kind of the Rodney Dangerfield of stocks. We get no respect. There's never been a Wall Street strategist in the history of the world who came out the first week of January and said, utilities are my favorite sector of the year, okay? Because they're all bullish. Yeah. They want you to take your money and invest it with them, and they don't want you to be in defensive sectors like utilities. But in the last 20 years, and I just looked this data up this morning, so you're starting in May of '99 at a time when everything was all tech all the time, internet, you talked about some of these things in your speech. and utilities were left for roadkill. In the 20 years ended April 30th of this year, utilities are up 7.2% per year for the last 20 years. The S&P 500 is up 6%, and the S&P 500 technology sector is up 6%.
So it's outperforming.
So utilities have outperformed tech for 20 years.
That's true.
All right, let's hear it for utilities, right?
I don't
Those
buy that.
unsexy utilities. Keith, what about you? Where are you? Has all of this hullabaloo changed your investment strategy?
Not one bit. What did we talk about yesterday? We talked about simplify. Everybody remember that word? Come on, say it with me. Simplify. I think this is a very complicated time. There's no doubt the computers are exacerbating that. You've got to be careful with risk management. But history shows very clearly missing opportunity is a far more expensive proposition than trying to second guess the inevitable. So to me, yes, I think we've got a long way to go. It's the right set of circumstances that can come into place. If you're not in to win, you're going to lose.
So you're not limiting your exposure to U.S. equities right now?
Not at all. It's the best looking horse in the glue factory.
And what are you most heavily invested in? What sector?
Well, right now we're looking very keen at a lot of the things that have been hammered very, very hard over the last couple of weeks. We're looking at certain medical technology, we're looking at defense, we're looking at big tech, all of which are changing the world, all of which are backed by unstoppable trends, and all of which make must-have products. Of course, risk management is not an option, but that's where we are.
Right, all right. Mark, weigh in for us.
So Alexis, as many of you know, I'm a collector of Wall Street sayings, and I'm reminded of several referring to what's happened this week. One is never sell on Monday. And this happens over and over again where the market overreacts on a Monday. And we're seeing that again with this rally on Tuesday. The other one is bears make headlines, bulls make money. Those who have been calling for the mother of all bear markets have been rudely awakened by a mother of all bull markets. And the other question is this mother of all bull markets, is it over? And another great saying on Wall Street is that bull markets never die of natural causes. They're always murdered. And who is it that murders a bull market? Well, it can be the Fed raising rates too fast, and they have decided. I think that's very important. They've decided not to raise rates this year, from what I can tell. So that's one reason the market has rallied as it has. This trade war is a serious threat to this bull market, and don't ever underestimate the size of globalization in the world. In the United States, and we don't do a lot of global trade compared to other countries, compared to Germany, Europe, Asia, Panama, Japan, and so forth. But still, 29% of our economy is related to either exports or imports. So there is justification in this market being hit hard when Trump advocates a protectionist policy. And if it becomes permanent in any sense of the word, that could be a danger to this bull market.
I mean, Peter, do you think that the China, I mean, you don't think it's our number one problem right now, you say it's the Fed, but does this China-US trade war, could this precipitate a stock market crash?
Well, there are a lot of things that could precipitate a crash, and the market's headed lower. And I think the market underreacted on Monday to the news. If people actually perceived the dangers that are there. I mean, Mark, you talk about trade is not as important to us. I would say that the United States depends more on imports than any other country. We don't produce most of the manufactured stuff that we consume. All of it has to be imported. We rely more than any other country on foreign savings. I mean, we have tremendous debt in the United States. The federal government, corporations, individuals, local governments, states, and we have minimal savings. So we have to borrow money from the rest of the world in order to fund the economy. That's what's keeping this whole thing afloat. Donald Trump in his press conference the other day mentioned about once upon a time when America had a special economy. We actually had a strong economy where we actually manufactured and we exported. And we did that because we had limited government, we had sound money, we had few regulations, we had low taxes. We're not that nation today. And the only thing that's been keeping us afloat has been the ability to live on the productivity of foreigners and the savings of foreigners. And this relationship is in jeopardy right now. When Donald Trump says that the Chinese have been giving a free ride, he's got it backwards. We are living off of China and a lot of other countries who supply us with stuff that we cannot produce and lend us money that we have not saved so that we can live beyond our means. means, and that we don't have to save and we don't have to make the capital investments.
Peter, you're making so many statements that are extreme. You sound like Donald Trump.
Well, they're true statements.
And,
that's the difference between me and Trump.
No, I mean, you're looking at just half the glass and it's empty. Foreigners are huge investors. They don't just loan money.
But we don't pay it
invest.
back.
And not only
We don't
that,
have
but
to.
the United States, yes, we have a debt problem, but it's much more serious in Japan. It's
No, it's
much more
not.
serious in, yes,
We
it
owe
is.
Japan. Japan owes $1 trillion of treasuries.
Have you been
we
to
owe
Japan
them.
recently?
No, but
Well,
have
you
been
should,
there?
because it's a dynamic economy. Those Japanese
Yes,
are working
it is.
24 hours a day. They're great people, and they do help us out with borrowing and so forth. The other thing I want to point out is I teach at Chapman University. I've taught at Columbia Business School, and I show every student a very important chart that demonstrates, or not a chart, but a table that demonstrates that we are manufacturers, that we are exporters. We are not just importers. And there are literally billions and billions of exports. So,
But net, we have the largest trade
give the
deficits
full
in our
story.
history right now. I mean, if we're such a big manufacturer, where are our surpluses? Why aren't we? Why do we have to import so
Let
much
me
from other
interject.
countries?
Why then would China retaliate with such little tariffs, $60 billion worth, right, of tariffs on our goods, and at the same time we're seeing the yuan get devalued? What does that mean?
Well, remember, the tariffs hurt the individuals who pay the tariffs. The country imposing the tariffs, it's the American people that pay our tariffs, and it's the Chinese people that will have to pay their tariffs. So it doesn't hurt China to not have tariffs. I mean, free trade benefits the countries that are engaging in it. And if we want to tax Americans for buying foreign products, then that's just a tax hike.
President Trump for a long time has said China manipulates their currency. Do you think, Tom, that China right now is going to be using their currency not as an economic tool, but as a political tool? And if the value of their currency gets so low, will they be forced to capitulate to President Trump?
Well, the beauty of what we do at my firm is we focus on individual companies, so we don't have to worry about all these macroeconomic
The
issues.
smart utility
which
guy.
make your head spin and make you afraid to invest. So whenever these fears crop up about the strength of the dollar or trade wars, again, if you're in some of the sectors that we're in, especially utilities, that becomes the safe haven where they don't have exposure to these things. And for the average investor who's coming to the Money Show, or a good portion of the U.S. population is either in retirement or nearing retirement, and they're concerned about one thing: how do I take the savings that I've accumulated and have it safely generate income and preserve the capital for the next 20 or 30 years that I'm going to be alive? And that's what we focus on. So we want to find good companies running their business well, in stable businesses like utilities, throwing off income and raising the dividend every year. We've been in a low interest rate environment for a long time, which has been very good, and I think it will continue because some of the things Peter's talked about, the levels of debt, we can't raise interest rates.
Right.
Every time someone says, I don't want to invest with you, I'm scared about rising interest rates,
That's not the
it lasts
fear right
about
now.
2 months and then the fear goes away.
I think you raise a very valid point, because politicians want to spend everybody else's money. CEOs want to generate money. So if you're an investor, I submit it is a more powerful argument for your own fiscal well-being, for your own profits, to go after the CEOs who have to deal with this, making real money and real decisions every single day, as opposed to politicians or academics who are playing with fancy pants models that have no bearing in reality. So from an investment standpoint, you asked me earlier, have I changed my strategy? No way. I'm still focused on the CEOs, because they're the ones making decisions with real trillion-dollar consequences, not politicians who are saying this might happen, this might not.
But Tom brings up a good point, excuse me, but that a lot of folks are near or in retirement. If
Absolutely.
your time horizon is not that long, can you really afford to let it roll, so to speak, in this market right now in these conditions? Or should you take some money off the table?
I don't think.
Should you reallocate?
See, to let it roll is not a word that I would put in my vocabulary. Buy and hope is not a management strategy. Is it? Anybody? No? No, buy and hope does not work, but buy and manage does. And if you're managing the CEO, you're managing the products, you're looking for the world's best companies who are changing the world we live in, they can protect their margins, they can or cannot export, they can or cannot import, you know what? You got a winner, I submit. And then it's all about risk management. That's the part where we as individuals have an advantage.
You know, retirement is an extremely important point. I'm sure everyone is worried about this, but you know, I tell people all the time who are reluctant to spend, and young people are reluctant to save, and old people are reluctant to spend. And I tell almost everybody, when you say, oh, I can't do this, I can't buy this, I can't go on this cruise, I can't do this, I say, listen, you're going to die a millionaire. Spend your children's money.
I want to make this a couple of points, because you mentioned that, you know, these low interest rates have been good. They haven't. The low interest rates are the source of our problems. Tremendous misallocations of resources and malinvestments have been the byproduct of these artificially low interest rates. That's why we had a housing bubble. The financial crisis was the payback for the Fed keeping interest rates too low for too long. Well, this time they've kept them lower longer, and what the Fed is resisting is the market's attempt to rebalance the economy. We need higher interest rates, but the Fed is afraid of allowing that to happen, so they are extending or prolonging the pain, but exacerbating the problem, meaning we're going to have even more pain. But I also wanted to mention on currency, when you talked about China, and this is a big misnomer, the best thing that can happen to China is for its currency to rise. I mean, a weak yuan has been benefiting the United States because it helps us buy Chinese products cheaper. If the Chinese simply refrain from buying U.S. treasuries or sell their treasuries or let them mature and just allow the dollar to fall and their own currency to rise, that increases the purchasing power of their own citizens. And now Chinese companies can earn a higher dollar value for their production by selling their products to their own citizens than by exporting them to the United States. And that's what benefits China, because now they get the fruits of their own labor instead of allowing Americans to enjoy those fruits.
But that's not what they're saying. In fact, their currency is going lower.
No, but yes, it is going to go higher ultimately, and that's going to benefit. Everybody thinks that China needs and wants a lower currency. That's why they think they're never going to stop buying treasuries and lending money to the United States. But they've got that wrong. What China needs is a stronger currency. They have lots of savings. Their savings will increase in value. Their workers' incomes will increase. And you have a whole nation of consumers who don't have any debt. You know, American consumers are loaded up with debt, record credit card, auto debt, student loans. We can only buy things if we can keep borrowing the money. But the Chinese have real incomes, real savings, real jobs, and they would make much better consumers for Chinese manufacturers than Americans.
Low rates, I agree with you, are not good, especially if you're 60 or 70 years old and you've saved your whole life and you want to get a return on that without taking too much risk. So, but the reality is that's the environment we're in. Every time rates have started to move up in the U.S., the dollar has strengthened so much because rates are even lower in the rest of the world with $10 trillion of negative yield government debt.
The thing is, low interest rates has been a boon to your business. Without the lower interest rates, you wouldn't even be on this panel.
But it's been terrible for mainstream America. For the, you know,
I mean,
it's been a boon to
you do not want higher interest rates because that's going to kill the utilities.
Wait a minute.
A lot of bubbles are going to pop when interest rates go up. But that's why we haven't had the capital investment. That's why we haven't had real economic growth. We just had imaginary growth created by statistics.
But if we get down to where we are all concerned as real investors, you know, low interest rates, we can argue till we're blue in the face, good, bad, ugly, indifferent, whatever. Amazon's up 2,948.65% from 2009 to yesterday.
And how about gold?
And every $10,000.
How about gold?
That's 304,000. Okay, gold is up 45%.
Well, you know what? That brings up a good point.
And gold, so Amazon, if you'd invested in Amazon, this is not some little company nobody's heard of, right?
Yeah, but the other factor, though,
but you're talking about $304.9 thousand for every 10,000 invested. Gold is up 45%. So I submit we can argue again about what politicians are doing. We can argue about debt. We can argue about this. But as an investor, there's very real consequences to not being in to win.
Right. But there's also consequences when governments manipulate the market. I mean, there's a big.
Yeah, but as individual investors, can we do something about that?
No, but no. If you either believe in capitalism or you believe in socialism. If you believe in capitalism, you believe in the free market and price discovery. And interest rates should not be picked by a bunch of bureaucrats who want to decide what the interest rate should be. We need to let the free market decide on the interest rate so that we have a proper amount of savings and investment in the economy, and we have artificial manipulation. We have the central bank
Zero disagreement.
So that causes
but
problems.
Invest.
I think that's another great fascinating panel, whether or not the Fed, we need the Federal Reserve.
Well, and
please.
Alexis,
Fed needs to hang up a door that says we screwed up and we're out.
One thing that's overlooked here is the bond market rules in large measure, and one of the reasons rates have been dropping is because the bond market has been rallying here. The other thing I want to mention is that corporations, the financial crisis of 2008 really scared major corporations. And so they have not overloaded in debt. What they've done is they have a huge cash position. They don't know what to do with it, so they buy back their stock, or they pay higher dividends, or they pay their employees more. They've never had a stronger balance sheet than they do now. And so while individuals and student loans are a problem and government is a problem, the private sector has really done a pretty good job. And that's why I think one reason I'm bullish on the stock market, and I think this is a unique environment for us to be invested.
Yeah, I don't know. I don't know where you're looking at. I mean, there's a lot of corporate debt, and a lot of that debt, by the way, you know, when the economy goes into recession, you have a lot of debt that's going to get downgraded to junk. I mean, there's a lot of stuff that is actually investment grade right now.
But it's just the opposite. That they're not. The ratings are going up on one corporation after another. In the utilities, look at the S&P ratings that have been going up almost every year. It's been fantastic.
This coming recession is going to be particularly severe, and it's going to be exacerbated by increasing inflation. It's been a long time since Americans have experienced rising prices, significant rising prices, and recession simultaneously. But that's where we're headed. And a lot of borrowers, a lot of corporate borrowers are going to be in default in that environment.
How bad can it get, at least in the short term? Because UBS came out today and actually said they're predicting S&P at around 2,500. It's around 2,800 right now. So if we saw a drop like that, that would be about 11 or 12%. That would be pretty ugly. Let me just go down the panel, and Mark, I'll start with you. A decline of what, 5%, 10%? Are we looking at a bear market in the near term?
Listen, I go back to 1962, and I know that goes back a long ways, but you had a 30% decline in the stock market with a very tepid recession in 61, 62. And so that's an example of how, you know, Wall Street exaggerates everything. We all know that. The business of investing is not the same as investing in a business. Wall Street and Main Street don't go together. But in the long term, they do. In the long term, they do. So yes, anything is possible on Wall Street. And this trade war is a great uncertainty. Globalization is really important, and it's being threatened now at every level because everybody wants to do what Trump is doing. America first, Europe first, Japan first, China first. You know, everybody can't be first. So we need a little more Christian charity when it comes to helping people out. And let me give you an example of that. You know, Donald Trump the other day said, wouldn't it be great if the iPhone was all made in America? Well, think of all the Chinese. We've given hope to millions of Chinese like never before. And is not that the right attitude? Okay, yes, it created some imbalances and some people got laid off in the United States. But as I tell my students, labor is the most flexible of all the factors of production, and we can be retrained, we can get other jobs. But to help out the Chinese people and to give them freedom for the first time, economic freedom, is something we don't want to reverse.
A little humanity in all of this. Thank you, Mark.
Exactly, a little humanity. Well said.
Keith, what about you? What are you predicting as you look in your crystal ball?
Well, I'm still looking to be in to win. I mean, you know, I want the best companies and the best profits because
even if they have exposure to China right now, like Apple, like Amazon, like Caterpillar?
No question in my mind, because, you know, having spent a lot of time in that world, you know, 30 years at this point in the Far East, you know, I've seen it firsthand. I know what that's about. You know, the only place where Israeli diamond merchants get out and negotiate is Shanghai. You know, people forget that the Chinese invented money. I mean, they've had the world's largest GDP for 18 out of the last 20 centuries. Not months, not years, centuries. So I kind of think
they
that,
like
you know,
gold.
The anachronism here is us. So if I look at this and I put on that hat and I start viewing it through a much longer term lens, again, I've lived through this rise and fall with Japan firsthand. I've lived through this with other nations in Europe. I've lived through this watching the Middle East. Capital flows like water to where it's treated best.
Yeah.
So as an investor, my job is to help all of you find that. So am I concerned? No.
This is the part of the where we get a little more bearish as we
Yes.
move closer to me. What about you, Tom?
Well,
He's going to watch paint dry and get good
And
returns
get good
doing
returns
it.
because of it.
Exactly.
I'm fortunate to have been in a firm that's been investing real money in real portfolios for 41 years. We started in 1978. The 80s and the 90s, the S&P 500 went up 17% a year. And believe it or not, a portfolio of utilities, energy stocks, and telephone stocks also went up 17% a year. Then we hit 2000 to 2010, when if you stayed in the S&P 500, you lost almost half your money over that period, and we still grew your capital over that period. And then we've had the most recent 10 years, the market's up again mid to high teens, we're up low teens. Okay? Not too bad for the conservative part of your portfolio. So if you think in 10-year increments, 17, down, back to mid-teens, I think it's likely returns will be lower for the following 10 years, and that's when a strategy like ours, you're in good companies, steady, essential businesses that grow their earnings, grow their dividends, aren't going to be displaced. There isn't a new technology coming along that's going to replace electricity as we do it today.
Right.
And
we
the
don't
companies,
know.
people worried about solar and wind and all these things, the biggest investors in renewables today are the existing utility companies. NextEra Energy, the biggest company in the S&P 500 utilities index, is the biggest investor in the world in renewable generation. It's cheaper to run, it's making their business more efficient, it's making the regulators happy, it's keeping bills lower for customers. So the fundamentals of the sectors we invest in are really terrific. And if the market gets rough for the next 10 years, this is a great place to be, especially for people who want to preserve and grow their money slow and steady. We're the tortoise and the hare. We're the tortoise.
Yeah.
Let all the hares run around all over the place.
Is that what we're in for, though? A long period, 10 years, where this market could be down?
Well, it could be down a lot. Look, the last two bubbles, when the dot-com bubble popped and when the housing bubble popped, the S&P was cut in half. The bubble we have now is much larger than both those bubbles combined. So we easily have a 50% downside risk in this market right now. But the bigger problem is when the Fed goes back to the punch bowl, and when it tries to reflate the bubble again, right, when it tries to stimulate everything with cheap money, it's not going to work. We are going to have a dollar crisis. The reason that we didn't have it before, and if you remember, initially people were smart enough to be worried about QE. Gold went up to 1,900 in 2011 because people actually thought this was a bad idea. They were right. They just don't know how right. Because what happened was the Fed then convinced everybody that it was going to work and that it was temporary and that they had an exit strategy and that as soon as the emergency was over, they would normalize rates, they would shrink their balance sheet back down to where it was before the crisis began. Well, when they have to go back to zero again, right, when the budget deficits are $3 trillion a year because they're $1.5 trillion now and we're not even in recession, so when they have to go back to zero, when the balance sheet blows up above 10 trillion, when the national debt's 30, 40 trillion, right, nobody is going to believe they're going to be able to normalize rates. Nobody is going to believe they're going to be able to shrink the balance sheet. And so there's going to be nothing supporting the dollar. It's going to fall through the floor. And so then, when that happens, when we have a dollar crisis, talk about exports, if we want to import, we're going to have to export, because right now we're able to import because people want our money. They want our financial assets. Well, in the future, they're not going to want our dollars. They're only going to want stuff that we produce. So if we want to import those things from China, we're going to have to make something that the Chinese want, because we're not going to get a free ride. We're not just going to print while everybody else is working.
If we're going to hell in a handbasket, what are all these fine investors to do? Do we look at other asset allocations? Look at Bitcoin. Guys, Bitcoin is the best.
Don't even get me started.
Because
Don't even get me
it
started.
is the best performing asset of the past week. That the numbers show.
No, there's probably a winning lottery ticket that beat it,
Do you go to gold? How do you hedge? How do you hedge?
Nobody's more bearish than a sold-out bull, right? You sold out your
Always,
your Bitcoin. Huh?
say one of my sayings in Mark's book, he was kindly enough to include me, was always
Is there a place in one's portfolio
always
for a
sit in
little
an exit
Bitcoin?
roll.
No.
No.
But there is a place for some gold.
Okay.
There's a place for gold. But look, if you look at relative valuations, maybe Mark Skousen would agree with this. If you look at international stocks, emerging markets, they have never been this cheap relative to the United States. So even if the gloom and doom doesn't actually materialize, you're not going to hurt yourself by buying low, buying undervalued assets that have better dividend yields. But if I am right about the coming dollar crisis, I think we're going to see a boom in commodities, in emerging markets, and so that's where investors are going to make money. Not only are foreign stocks going to rise, but the currencies. And see, the big problem for the global economy has been the overvalued dollar and the rising dollar and the pressure that puts on local economies. It forces their inflation rates up, their interest rates up. It causes capital flight. But when the dollar starts to fall, that is massive relief around the world. All of a sudden, their dollar debts go away. Oh, yeah. Prices go down, capital, inflow. So America will suffer from a falling dollar because it's going to bring down our standard of living and cause our cost of living to go up. But the rest of the world is going to benefit, and you need to be invested there.
I'll give you a quick quote that you would appreciate and everyone else. Nothing makes the spirit fly higher than finding a bargain when you're the buyer. And nothing can make the spirit sink deeper than finding it later a whole lot cheaper.
Well said. So Peter brings up commodities, maybe the precious metals, but oil. Oil could be in for a trip now that we're having these issues with Iran, right?
I like oil a lot, and it's countering. It's quoted in dollars. The dollar's been strong, but oil has been making a really nice rally as opposed to gold, which is now under $1,300 an ounce. It's pretty clear to me that oil is a much better choice than gold.
Yeah, gold just reflects a lot of complacency. People out there don't realize the risks that are out there. They still have confidence in the Fed, confidence in other central bankers, confidence in the U.S. economy. That will fade.
Well, and you have
when it does, they're going to be chasing
you have
gold.
Bitcoin, and other digital currencies which are competition to gold.
Not to gold. I mean, they're probably competition to other forms of gambling.
All the speculative
I don't think there's any competition there to gold. I don't think there's anything that Bitcoin and gold have in common.
I do, and respectfully, I think it's not a direct competition. I think what happened is a lot of the speculative energy that formerly drove gold to such levels and such volatility has moved into other asset classes, not the least of which.
Well, I do think
gold bugs are attracted to Bitcoin and other currencies because it is a way to escape the dollar, that is one of the factors that's at work, Peter. You can't ignore that.
No, I do agree, and they have a big marketing campaign now in the Bitcoin community to try to market Bitcoin as some kind of new gold. I mean, I think it's fool's gold. But clearly, and they get the price to move up, and they try to contrast that to gold. Oh, look, see, Bitcoin is really going up, and so it's better than gold. But gold is not rising right now because the dollar's not falling. People are still confident in financial assets. When they lose that confidence, they're going to go to gold. They're not going to buy Bitcoin. I mean, Bitcoin ultimately is going to collapse. I think there'll be a crisis in these fiat, in the cryptocurrency.
It already did collapse.
Now, I think the bubble already peaked. I mean, we'll see. We're up around 8,000 now.
Bitcoin,
but we went up to 20,000.
Yes,
everybody got all
year.
Excited about it. Well, then it went down to 3,000.
96 or 97% of all Bitcoin assets and value are controlled by less than 4% of the addresses. Right. And on top of that, you've had billions of dollars stolen. Bitcoin is used for illicit drugs, for prostitution, for weapons dealers.
Mark has some real money.
Gold coin, but and
you want to speculate on that?
You can't do this with a Bitcoin.
Right.
You can't do anything with Bitcoin.
But you can do this with gold.
Exactly.
You can do and of course, all the Bitcoin guys, in order to pretend Bitcoin has value, they have to pretend gold has none. They pretend that there's nothing you can do with gold. It's a useless metal, when gold is in fact the most useful metal that we have. There are more uses for gold. In fact, they would use gold more if it was less expensive, but they can't. So when they really need the best, they use gold.
I just want to get back to oil for a moment. Do any of you on this panel think we're going to see $100 crude anytime soon?
We're going to see much higher than $100 crude, but the dollar will have to start to fall. I mean, Mark has mentioned that the oil has been strengthening despite the fact that the dollar's been strong. But when the dollar falls, and it's going to be the biggest bear market the dollar's ever had. No, the dollar's been falling for 50 years. Ever since we went off the gold standard in 1971, you can look at the Deutsche Mark, you can look at the Swiss franc, look at the Japanese yen, look at gold. The dollar has been losing a lot of value. That trend is going to continue because it's powered by our trade deficits and our budget deficits, which have never been larger. But this next dollar decline, I think oil is going to take out the highs from 2008, which was around $140, $150 a barrel.
That's going to be a little inflationary.
He is ignoring the supply side, though, and fracking and so on is a tremendous new technology. And,
it's overhyped.
And we're the world's largest producer now of oil and gas.
Right.
In fact, natural gas now is so cheap they're giving it away. I mean, it's just an unbelievable situation. So you can't ignore the supply side of it. I agree with Peter that demand, I mean, you know, if you're inflating constantly, that's going to increase demand. But it is interesting that it's been a gradual rise in oil prices, around 62, but 100, I don't see it in the short term.
Yeah.
right.
Well, it's not until the dollar falls.
Yeah, Keith.
Just, I think, again, you know, for all of the stuff we've discussed here, for all of the machinations we're going through, I think the mental gymnastics are very simple. I think you go with the things that matter in our world today. The technology that's changing. You look at defense, that's not an option. You look at some of the medical stuff that we all require as we're getting age. You know, these are the areas in today's markets that are valuable almost at any price. And everything else is risk management.
I'll tell you an interesting statistic. The survey said 51% of millionaire Chinese want to move to the United States. 51%.
Wow.
Yep.
We haven't even
Grass is always
discussed
greener,
immigration, and that's a big issue too. Will we have the immigrants to come into this country? Will we have the ones that run most of the technology companies these days are foreigners?
Yeah.
Are we still going to have that? That's a good long-term
See, that's another
question.
panel, right? We're going to have one on the Fed, do we need them? We're going to have one on immigration. Back to the markets quickly, we have a few minutes left. Just a few weeks ago, there was no volatility. This was a very calm market.
Yeah.
Volume wasn't that high. What's an investor to do? I'll start at that end and we'll come around. And if volatility is going to be the name of the game for the foreseeable future, what's an investor to do?
Well, I
Celebrate.
agree with Thomas that dividend-paying stocks, especially rising dividends, that cushions the fall. You know, it'll be cyclical, just like any area. But I've been recommending in my own newsletter a number of income-producing stocks in companies that are fundamentally sound. They're making money. Their payout ratio is less.
Give us a couple of names, Mark.
Main Street Capital, Care Trust is really a good one. Enterprise Products, the pipeline company. They all have a rising dividend policy, and they're growing. They're making money. So we're going to get income, but we're also going to get capital gains in the long term.
Keith.
Well, again, you know, I want to find those areas of the market that are under a lot of pressure and have products and services led by competent CEOs who are going to solve many of the problems we talked about. They have to make money no matter whether interest rates rise. They have to make money no matter whether interest rates fall. They have to make money no matter whether there's a deal with China or without China.
And I think Microsoft is a very good example of that. Under Nadella, he's been fantastic in
I think Microsoft's
turning that
management is
around.
the best it's been in years.
Yep.
So to me, I'm looking at Microsoft for big data. I'm looking at Amazon for the consumer play. I'm looking at Google because of the way they're handling the alternative science. I'm looking at Raytheon because of its
Yeah, but
defense.
Google is a great evil.
But can you make money from it?
It doesn't matter because Google is a very dangerous. They are infiltrating the minds of every American.
But you know,
And
my
it's very
job,
scary
my
what those
job,
people are doing.
my job as
Very
an investment
scary.
strategist is to identify opportunity.
Well, don't use their search engine then.
Don't use the search engine. Is right.
No one's forcing you to use Google.
They will tell you who you are and start promoting your advertising to you.
Google heard that.
Alexis,
We stick with Yahoo.
There, I like that. You're searching on Yahoo.
no surprise that in a more volatile environment, we think the utilities will continue to shine. Oil stocks are very cheap compared to how they've been historically. And the important thing is we've been following them for 40 years, and we have no idea if the price of oil is going higher or lower. We focus on the companies and at what price can they still make money.
Right.
If we look at the downside,
Exactly.
if oil goes back to 40, who can still make money? Royal Dutch Shell fell to $35, $38 a share after oil cracked
Yep.
in 2014 and still maintained its dividend. Today, because of cost cutting, it's looking at potentially raising the dividend in the next year, and it's buying back a lot of stock.
Yep.
Chevron, the same thing. So companies that can use technology to make their businesses more efficient lets them generate more cash that they can return to us, the investors, so we have income to live on and enjoy our lives in retirement.
Yeah, I mean, my advice is actually pretty simple. I would be selling U.S. stocks, U.S. bonds, the U.S. dollar. They're all overvalued. They're all going lower. But alternatively, I would invest in stocks internationally. I would find value in countries that have, less regulations and lower taxes, that have trade surpluses and don't have the type of debt that the United States has. There are plenty of good dividend-paying stocks around the world that will see appreciating stock prices, that pay good current dividends now that are much higher than what you would get domestically. And more importantly, those dividends are paid in currencies that I believe are going to gain tremendously in value relative to the U.S. dollar. So you gain on the currency, you gain on the dividend, and you gain on the stock. And you should also have some gold in your portfolio as well. You don't have to go overboard. 5 to 10% should be fine. Most investors have nothing in gold, and I think that's a huge mistake. I look at gold as cash, as money. It's not really an investment. It's just something to own instead of the substitutes that are being created by global central banks, which are guaranteed to lose purchasing power. They tell you that. Right now you have central banks that are saying our goal is to destroy 2% of the value of these currencies every year, and they will succeed. At one point, their goal was price stability, and they failed. Now their goal is prices going up. So you want to hold real money, not government fiat.
All right, unfortunately, that's all the time we have, but it was such a delight spending the morning with all of you and all of you. Thank you so much.
Thank you, everybody. Thank you, Mark.
Fantastic panel. Thank you, Alexis and panel experts. Round of applause, please. Fascinating, dynamic panel. Thank you. I have a couple of things for you. I have promised Peter Schiff to announce that he has